In this video, we're going to unveil how you could pay off your mortgage in as little as 5 to 7 years, using a concept known as the Accelerated Payoff concept. It involves using a line of credit, like a home equity line of credit. But even with the higher interest rates that you pay on a home equity line of credit, results may surprise you. By the way, my name is Joe Vrankin. I'm a CPA and I have an MBA in finance. I've been in both corporate and personal finance for over 25 years. By the end of this video, you'll become familiar with the accelerated payoff concept, and I'll explain it in the simplest way possible. So let's dive right in. So we begin by understanding just how expensive a mortgage can be and the way it's designed for you and everybody else to pay a lot of interest over that 30-year span. So let's take a look at how a 30-year mortgage amortization works. If you look at an amortization schedule, and let's say you have a $300,000 mortgage, and this is your timeline. So you start at year 0 and you're fully paid off at year 30. Well, we'd like to believe that what happens is when we make our mortgage payments, that the principal balance goes down in a linear line, right? So this line represents what your principal balance is. The reality is the amortization schedule doesn't work that way. It actually works more like this. So you get 15 years into your mortgage and you haven't paid off nearly as much as you think you probably have. You'd like to believe I'm 15 years in, so I've probably paid off close to half of my mortgage balance. But the reality is, early on, the vast majority of the interest, or the vast majority of your payment, is actually going to interest, and very little is actually going to the principal paydown. It isn't until you get to the later stages of that 30-year mortgage that the majority of your monthly payment is actually reducing the principal amount. So now let's talk about how the accelerated payoff strategy works and how it can help you pay off that mortgage in a lot faster time frame and save you an awful lot of interest. First, we need to get familiar with what a line of credit is, specifically a home equity line of credit or a HELOC. Why do we use a HELOC? It's different to understand that a HELOC can be accessed and paid back as often as you like. So the concept of a line of credit, and let's in this example say you have a $50,000 line of credit, you can borrow, say, $25,000, and then you can pay that $25,000 back whenever you want and as quickly as you want. And then you can access that money again. Whereas a mortgage works in just one way. You borrow the money up front, you pay the mortgage down, but you never have the ability to take anything back. The second difference is a home equity line of credit uses a daily balance for interest calculation, whereas a mortgage uses a monthly balance for interest calculation. With a mortgage, the interest is calculated on the month's ending balance, but with a HELOC, the interest is calculated based on a daily ending balance. So here's the big picture of how the strategy works. And I'll explain how it saves money and how it's related to interest calculations. Okay, so now let's go through how you want to utilize the HELOC to pay down your mortgage and what the benefit is to having the HELOC. So if we go back to our amortization schedule and we go back to our $300,000 original mortgage at year 0, we have our traditional schedule here, and this is year 30. So let's say that we're 5 years in, okay? And at 5 years in, we're here, and our principal balance remaining, we're going to call, is at $275,000. Now we set up a $50,000 HELOC. We don't tap into all $50,000, and I'll explain that in a minute, but we tap 25, and we make a $25,000 principal payment to our mortgage. So now we pay $25,000, and now our balance is $250,000. So here's what happens now to that amortization schedule because you've made a big chunk principal payment. It goes down like that because now every month that you're making your mortgage payment, more of that is going to principal. Now we look at the HELOC, and all of your paycheck goes into the HELOC, and any other income that you generate each month goes into the HELOC. And we take out all of the expenses that you currently spend, and the excess cash that you have every month is paying down the balance on that HELOC. But it's doing it on a real-time basis. If you get paid every week, then the excess cash that you have at the end of each week, or at the end of each day for that matter, can go down and pay the principal balance, a principal payment to the HELOC, thus reducing that faster and saving interest because the interest is calculated daily and not monthly. So now you bring down and you pay down that HELOC to zero again. So you now make another $25,000 draw on the HELOC, and let's say you're here, and you make another $25,000 payment. So now you're at $225,000. Now that amortization schedule is going like this. So you can see as you do that, you're paying off your mortgage exponentially faster, and therefore a 30-year mortgage with 25 years left on it can be paid off in as little as 5 to 7 years. And you get the benefit of the interest savings by taking advantage of your HELOC because you are paying interest on a daily basis. And by reducing your principal payments through your excess cash flow on a daily basis, you're saving interest in doing so. The other advantage to the HELOC, and the reason I had given the example of setting up a $50,000 HELOC, but only drawing $25,000 to make a chunk payment on your principal, is it provides a safety net for you for life's curveballs. If something happens and you need access to additional cash, you can draw on that from your home equity line of credit. And that provides essentially a financial insurance net for you that doesn't exist with a traditional mortgage. You have to make that payment every month, regardless of what else happens in your life. And it'd be nice if there's no curveballs in life, but life doesn't typically happen that way. So as you can see, the Accelerated Strategy program has huge advantages of creating financial security and independence. It can save you hundreds of thousands of dollars of interest payments over the life of your mortgage and pay that mortgage off in as little as 5 to 7 years. So I invite you to learn more about our concept. See if it fits for you. Right? If you'd like to learn more about our concept, we have a lot of YouTube video channels, as well as resources in our video library in the description below.